Normally, Alphabet would be our top story. After all, if we don't mention one of the FANG stocks every 15 minutes, we might actually explode. But as incredible as Alphabet is, and at the risk of spontaneously combusting, there was an even more stunning move in the market today that could have an even bigger impact on your money.
Like the drummer in Spinal Tap.
Yes.
No. Oh. The rate shock heard around the world. The 10-year yield surging to its highest level in a month on reports that the Bank of Japan could be on the verge of a major policy change. This as everyone awaits the ECB decision this week, the Fed next week. Are we witnessing the potential end of free money around the world? And why aren't we seeing more of a reaction in the stock market today, Guy?
Answer the first question is yes. I mean, Bank of Japan, that seems to be in a total about-face, seemingly out of nowhere. I would submit, and Tim can speak to this probably more intelligently than I would submit it's on the back of some of the comments President Trump made over the last week and a half. But the reasons why probably don't matter. They will explain themselves. But the fact that they're getting away from the stimulus policy that's been in place for quite some time is alarming. It shocks me, to answer your second part of the question, that the markets don't seem to care. VIX actually went lower today. Stock market closes unchanged, and people continue on their merry way. I still submit, and I've been wrong now for a long time, but I think not necessarily central bank missteps, but central bank policy changes will put an end to this bull market at a certain point.
And you did that very well, by the way, Guy. But, ultimately, if you think about what central banks could be the most dangerous out there, it's not the Fed. Let's face it, the most manipulated bond curves in the world are, first of all, I think, in Europe. Although, if you look at what the BOJ has been doing, they've been yield targeting on the long end of the JGB curve, their government bond curve. And this is the second largest bond market in the world. So when you look at what's holding U.S. rates down, I actually think it's those other central banks. Now, I think there's a possibly decent or call it a silver lining for markets is that I think this is going to put upward pressure on the yen, as it did 2 days ago. I think it's going to put upward pressure on the euro because I think the central bank differentials will come back together, which means that the dollar is stuck here, and I think that's what President Trump wants.
Yeah, well, so, look at what happened today. We had a rise in 10-year yields. Basically, the big trade out there has been, listen, I can borrow cheaply someplace else, Japan. I can borrow in Europe at less than 1%. I can come over here and buy 10-year treasuries and get 2 3/4, the carry trade. It's been the huge trade out here, and as soon as that starts to unwind, then you get these big repercussions. Now, to answer your question, why the stock market didn't react, we actually had some decent economic news here today, right? At least from my stance. We had Chicago Fed National Activity Index, one of the highest levels in a long time. If you look at the City Economic Surprise Index, it's below zero, which means maybe we're troughing here. So, if rates rise, and you're getting a strong economy, that's not a bad thing. If rates rise and the economy's not strong, you're getting inflation, that type of thing, that's bad. But I think that's why stocks held up today.
I don't think the market cares about trade. I don't think the market cares about rates to the point of I think that Trump has put a lid onto Powell. So I don't think the markets are trying to interpret whether or not Powell's hands are tied. And I think that's what's going on.
Well, here's what I think. As far as I'm concerned, the bond market, the Fed isn't really in control of the long end of the curve, okay? They control short end of rates, but what the 10-year does is out of their control. So the good news for banks here, and look how banks have basically responded to this, is you've seen some slight steepening of the yield curve. Let's not get carried away because the 2 years now back at 263, which is effectively at 10-year highs. But it does mean that you could see the curve steepen because if the long end is truly to respond, which it does to inflation,
and that's why the financials have outperformed. And the question is, does that continue?
Well, here's the question. Let's game this out. Do we think that this is actually a steepening that is here to stay? In other words, that the Bank of Japan will actually go through with paring back on stimulus, and that this rate dynamic is in play, and the financials continue their run. If it's temporary, I would say the financials might not continue its run.
I think it's temporary. I think today gave air. I think that our Fed breathed a collective sigh of relief as this flattening yield curve unflattened for at least a day or two. And maybe you'll see it happen for the next, a week and a half or so. But I think a yield curve that has been flattening will continue to flatten over time. So I'm not convinced that the Bank of Japan's policy actions can help our yield curve steepen. But I would disagree with Steve a little bit. I don't necessarily think President Trump's comments tie the hands of Chairman Powell. What I think it did do is give President Trump an embedded put if the market were to go lower to say, I told you back in July that this Fed was going to raise rates, and there's
a win-win for him, but not necessarily for the markets.
So, I do think it's a win-win for the markets, and that's why the markets are breaking down.
Listen,
I think that what they're saying is
you don't want the market. The market does not want a Fed that is their hands are tied. The market wants an independent Fed. There's no way it's a win-win.
What I'm saying right now is if the Fed continues on a rate-rising pace, it's because the economy is doing well and there's no real aftershocks from a trade war. If there's an aftershock from the trade war, the Fed can back up a little. So I think he's painted him into a corner, Powell, that he likes to be in.
Unless the Fed is more boxed in to raising rates in December because of that President Trump tweet.
No,
right?
I still think they're independent.
You know what? We're doing whatever we want.
I tell you what, I think right now our Fed, fortunately, is an independent Fed. And I think the jury of proof will be that actually they're responding to pressure from the White House. Look, there's been enough pressure on the Fed by other people to say, hey, you know what? Look at the yield curve flattening. You're moving too fast. And even though we do have inflationary pressure, and I think we do, I think you can make an argument that even you had Fed Powell twice last week in front of Humphrey Hawkins' speech. You had a chance for him to try to, again, stay in his lane, but he got asked all the time about trade tariffs. He got asked about these exogenous factors. And the Fed responds to fiscal policy. They don't lead it. And I think that's what you're going to know about this Fed.
The bigger concern is not so much the bond market, it's the currency markets. It's the currency war that started last week, and this could be a reaction to it. I mean, we saw the dollar drop in reverse today. If you get another strong dollar bout here, that's the biggest concern. The market can handle higher rates as long as there's growth. The market can't handle a higher dollar for too long. The higher the dollar goes, it's like the new VIX. The higher it goes, the more risk in the global system.
Where were you and I last week around lunchtime? Remember, we did a TV show? The Pierre Hotel. What were we
yes,
doing?
Delivering Alpha. We're doing Power Lunch.
Lunchtime at the Pierre. Go ahead.
Delivering Alpha.
Delivering Alpha.
Still on CNBC. Some huge business people were there.
Yes.
And what did I say? I mean, you're always just in the gutter. Out of the gutter and back into financial
Mary Callahan Erdos
Mary
talked
Erdos
about
said the thing from JP Morgan Asset that said the thing that concerns them at JP Morgan is the speed with which currencies are moving. Very frank about that. BK's on board.
Bingo. That's the biggest risk to the global market right now. A currency war is not a good thing for anybody.
But I tell you what, I just quickly say it. If you look around the world, fundamentals, which currency would you say is trading off of its mark? To me, if any of them, it's probably the yen.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.